So we saw U.S. President Donald Trump say in an offhand way he plans to put a significant tariff, 50%, on copper imports. That pushed the metal into the largest one-day price surge yesterday ever recorded. Our guest says this latest increase in tariff pressure is likely to feed into inflation. Let's get more from Keith Buchanan, Senior Portfolio Manager at Globalt Investments. Keith, thanks very much. I know we don't know what shape the tariffs will ultimately take, but you do see them adding fuel to inflation.
Hi, and thanks for having me. We at our firm are really discussing and analyzing this on a day-to-day basis, very real time with our team. And we're exploring the ways that inflation and these types of tariffs can feed into our economy, whether it's a positive or negative way, and also on the short term versus long term. And we've seen the tariff conversation go from country by country to change trade imbalances and have an effect there, to now going from aluminum, steel, and also now to copper as an industrial input that feeds throughout our economy, particularly in the industrial base, the manufacturing base here in the U.S. So understanding how that plays into either, and who pays that toll. Tariff is a toll that's paid somewhere along the highway, whether it's importers or the end consumer or U.S. corporations somewhere in between. And if U.S. corporations absorb even some of it, that is a detriment to earnings growth. Mm-hmm. So all that collides here over the next several months, especially the last half of this year, as corporations try to understand how this works, and we as investors have to have a grasp on it as well.
Yeah, it's interesting. I mean, it's such a widespread metal. I'm thinking home construction. I mean, there's a fair amount of copper goes into a new home, so and all commercial construction, industrial too. So it's going to add costs for those sectors. Absolutely,
and that copper that's produced overseas will now probably at some point cost a little more. Mm-hmm. And what does the metal do that's mined and sold here in the U.S.? It's hard to imagine those prices will go down from this point. So yes, that adds costs into the construction of residential properties as well as non-residential, but also in the construction and building and manufacturing of appliances as well. So it's throughout our economy, and we're understanding that on a real-time basis.
You're watching, you say, rates, which are approaching a level, you say, that could begin to weigh on stocks. Now, do you mean bond yields primarily, or do you mean the Fed base rate?
All of the above. We've seen this level of the long-term rates, particularly 10-year, start to put pressure on equities over the past couple of months and the past several years. The most recent rally has happened without real relief on the rate front. And we're getting to a level here where, again, a lot of stories are coming together at once. We're getting back to levels where we saw pressure from the rate side, put pressure on equities on a couple of different ways, from analyzing risk assets. There's a cost of capital that has to weigh into that as well. But also the cost of capital feeds into how corporations generate earnings. And as rates go higher, that makes that cost of capital more expensive. Thus, the valuation of stocks in a traditional sense has pressure on it. So we're looking at this level of rates as something has to give. Either the valuation on earnings or the level of rates has to subside in order to give relief for this rally to continue. Either could happen, and I think this next couple of weeks is critically important to what direction this market takes on the rate side and equities as well.
So, for example, if the Fed doesn't cut this year, that looks like potentially bad news for stocks.
In a way, it does. If the Fed doesn't cut this year, long-term rates come down. That means that steepening has unwound some. That usually is a signal of economic pressure that I don't think anyone wants to see here in the U.S. As well as globally. But if the Fed stays put because growth is strong enough and there's no reason to cut rates because inflation is still stubbornly high, growth is healthy enough to withstand more restrictive policy, then that's not necessarily a negative, and the long-term rate should stay higher. We're focused on the long end. The Federal Reserve is going to do what they're going to do. the long end is going to tell a complete story of what the market is baking in from an inflation standpoint, from a growth standpoint, and also from a fear and a safe haven aspect as well. So the 10 years really has our focus, and I think a lot of the marketplace, as well as the administration, has vocalized looking at the 10-year as a measure of risk, inflation expectations, and growth expectations as well.
Keith, leave us with a final thought. This earnings season, we're tight for time, but we may get more information about how companies are faring under the current tariff uncertainty and supply chain disruption.
Absolutely. This earnings season is critical. Every one is important, but this one really brings all the stories together where can the earnings growth beat expectations and justify these high valuations, which are currently, and as rates stay higher, getting more and more pressure from on a downward standpoint, and it helps to justify this recent rally we had if earnings can show resilience and even more growth than expected. So a lot is banking on, no pun intended, the bank starting this earnings season in a very positive way next